Welcome, everyone. A very, very warm welcome to all of you for joining us for today's workshop. The title for the workshop is Factor Analysis, a hands-on introductory workshop using Indian market data hosted by the CFA Society India. So I did like to take a moment to welcome our audience joining, from all across the world remotely. A very warm welcome to all of you. I am Ravi Saraugi. I am a SEBI registered investment advisor and co-founder of Samasthiti Advisors. On today's topic, it's very relevant for all investors and advisors. We are all alpha seekers, so to speak. We evaluate different investment products for their performance all the time. However, our toolbox for analyzing alpha or an investment product may still be, rudimentary, and there is always scope for it to be enhanced. And factor analysis is a very powerful technique that can significantly upskill our ability in analyzing investment products. So on this note, let's get started. Before I start with the workshop and introduce our speaker, I have a couple of housekeeping notes. So today's webinar is scheduled for 90 minutes, including presentation and live examples, and of course Q&A. Broadly, the format that we'll be following is we'll have the speaker present for about 40 odd minutes, and that's to present the theory using which the live examples will be conducted. But within this presentation, the speaker can take breaks and answer your questions. So you can actually populate your questions throughout the presentation itself. We'll have examples in Excel. We'll have examples in Python after the presentation. There is an online tool built by the speaker and his team, and we'll showcase that as well. And towards the end, we have further set aside time for Q&A. So we have a lot of time for Q&A, so please keep the questions coming. And you can click on the Q&A icon at the bottom and put in your questions. So we value your feedback, so please complete the evaluation survey before you sign off today. It allows us to get better. Please register for the upcoming 9th India Wealth Management Conference. The early bird offer ends on 1st July, so it's just around the corner. The conference will take place on 2nd August 2024 at St. Regis, Mumbai. And the theme for this year's edition of the Wealth Management Conference is From Disruption to Transformation. Also, reminder, please renew your CFA Society India membership to all the members. Don't miss out on the valuable resources and connections that come with being a member. To avoid, lapsing your member with CFA Society India for 2024-2025, take 5 minutes out today to complete, your renewal. It's my pleasure now to introduce Rajan Raju, who's the speaker for today and will be conducting the workshop. A very warm, welcome, Rajan. I think it's quite wonderful, really, to have you here with us. Rajan is the founder of a Singapore-based single-family office that invests globally. He is a published SSRN author. He's a seasoned board member, advisor, and visiting faculty member as well at academic institutions. He's a former career banker with strategic global roles. He holds a PGDM from IIM Ahmedabad and a BA in economics from St. Xavier's College, Mumbai. Welcome, Rajan. So before I hand over the floor to Rajan, we have a small survey just for us to gauge, the audience and, whether they have been exposed to this topic. So may I please request the team, to just have the survey and just give you a minute to just select, an option from the survey. So you should be able to see the poll in front of you. It'll be, request all of you to please fill that. It'll allow the speaker to moderate the discussion accordingly based on what we see in the survey. So we'll just have a minute for you to fill this. Okay, great. So now I think we can end the survey, and I would like to hand over the floor to Mr. Rajan. Rajan, welcome. Over to you.
Thank you. Can you just have a quick look at the results of the poll? Excellent. Excellent. So 40 people, 40%, 45% have got some familiarity. And 14% very, very familiar, which is great. And about, let's say, another 40% still early days. Okay, super. So once again, thank you, Ravi and the CFO Society for setting this up. Really appreciate it. This thing began, or this idea began as a discussion that Ravi and I were having around the use of factors from an Indian point of view. There's a lot of work that has happened with factors globally, and there's a lot of great research that happens globally. And there is a big leap that is made that says if it works outside, it must work in India. And since factors are empirical, based on data, one of the things that Ravi felt was why aren't we using the Indian evidence to kind of see if the factor effects are still the same in India as they are abroad. And the idea of today's workshop is really to try and make it such that it is fairly straightforward, kind of a very basic introduction, so that at least people get the broad concept rather than get into too much technical detail. I will cover some technical points because I think they are important, but I'll try and keep it as much conceptual so that anybody who's done high school should be able to understand it. Important disclaimer, none of this is financial advice. This is a workshop, so that's all it is. The objectives are really to start to introduce what does factor-based analysis mean. How do we get data, specifically from an India point of view, and how do we kind of analyze data and outcomes of factor-based analysis within the Indian context. Hopefully you should have some basic tools available, basic knowledge available, what to watch out for, so that when you apply factor analysis, you're avoiding the big kind of traps that any statistical analysis has. At the same time, you are applying the statistics the right way, so that when you get the results, you're able to understand what the results mean. So the agenda for me really was, I wanted to start from a practitioner's point of view. So I'm going to take a fund. Fund was chosen largely at random. It's a large cap fund. It is a fund that's one of the largest large caps within India. So this is not in any way a reflection of how the fund does or anything else. It is just that it was chosen random out of 4 funds. We'll start with that fund and we'll just work our way through how that fund would look like as one evaluates it. And the primary reason for the evaluation is to understand how factor-based approaches help you understand what drives fund returns. We'll spend a bit of time around both the Excel and with Python to try and talk through exactly how you will do the same thing. So again, depending upon your familiarity with either Excel or programming languages, this should be pretty straightforward. There will be a few minutes I'm going to spend on both statistical concepts, just to make sure that we understand the tools that we use. It's like a child, if you give the child a Formula One car, without telling the child how to drive the Formula One car, a crash is likely to happen. Whereas if you've given kind of basics of how cars work, some understanding of what to watch out for, the child is not just going to press the accelerator full blast. It will be a lot more nuanced. The second thing I want to spend a bit of time on is how Fama-French have constructed their model, because I think that's really important to understand. Again, you understand how the framework was set up and how the framework can be used by you from a practical point of view. I would just encourage you to keep writing your questions along the way. So Kapil, thank you very much for that question. I think we will talk about it in a short while. But the more questions you put in there, the better it would be for me to kind of wrap those up within this initial session, this initial theory or monologue kind of session. All right. So let's start with how we currently look at a fund. So the fund I've chosen is the ICICI Prudential Blue Chip. I've taken a screenshot from one of our popular screeners and things that people look at in terms of evaluating funds. And this is what it will show. You have the YTD 1 month, 3 months. So usually it will be some kind of time-based analysis, and people then choose 1 year, 3 years, 10 years, whatever is their flavor. And the key thing that most people tend to look at first is there a spread between the two lines? If the blue line, in this case ICICI Blue Chip, is doing better than their benchmark, let's say it is the equity large cap, that is a good fund, right? So that becomes the kind of a traditional baseline analysis. You would then go and look at what the objectives of the fund are. You would say, in this particular case, it seeks to do long-term capital appreciation and income distribution from a portfolio predominantly invested in equity and equity-related securities of large cap companies. I've highlighted portfolio, I've highlighted equity and equity-related and large cap, because all those are actually specific definitions. A portfolio means it is carefully constructed. There's a reason why he's got this portfolio and not some other portfolio. Equity and equity related it is stocks plus something that have got stock-like characteristics. And then large cap. Fortunately for us in India, SEBI has taken away a lot of our hard work and said large cap basically means the top 100 companies by market capitalization. What they have allowed for all fund managers to do, if you want to be classified as a large cap, is you need to have 80% of your exposure to these 100 companies, any of these 100 companies, and 20% you can do outside. The next thing that people look at is they look at the holdings. So if you look at ICICI Prudential Blue Chips holdings, you'll say, oh, it's got this company, and that's why it is good for me. And usually when you go to a fund manager, the fund manager will spend a lot of time about a story. He will say, I chose this company because of, I'll spend 25 minutes explaining to you why he chose that company, and then why it is so important for him in the portfolio. And then when you go back and look at the holdings, you say, but it's only 5%. Why should he give me such a long story for 5% return? So the key question really that comes out is, if I eat food, how much nutrition am I getting? Right? So a portfolio is food. But what is the nutrients that you're getting is something that you do not really get through a holdings-based analysis. And that's what this is. Financial academics started to kind of ask this question. Just like food has got protein, carbohydrate, fat, etc., how can I get those juices, those specific nuances of characteristics of food? And then if I'm able to quantify them, I'll be able to say, okay, if I eat this, I'm an athlete, I should have a higher protein count, so therefore I should be eating the following foods. Right? So they're trying to systematize what are the underlying constituents or drivers of return. And those are called factors. Right? Quite simply put, that's what is called factor. Now, the first thing you should understand is part of the problem of trying to understand a driver is it has to be statistically robust. It's not because Rajan said it is there, you should take me at face value. There has to be a scientific approach, scientific being evidence-based approach, to be able to say, here is how confident I am that this is the actual value of the food. Something like our ISI mark or something like the marks standards have within every country. So one of the tools that people use is called regression. I'm going to start with a very simple regression. It's a straight line regression. And all that you do is you have an independent variable. This is the explanatory variable. And you have a dependent variable, the variable that you're trying to understand what it's trying to do. So effectively what you're saying is, that the dependent variable will move based upon how the independent variable moves. And on the right-hand side, I've got a small little chart that shows an independent variable and a dependent variable, and I just plotted the points. When I plot the points, I'm going to get a kind of a mix. And what regression tries to do is it tries to minimize the sum of squared errors, which means it's trying to find the line of best fit. Ideally, if all the points fit on the line, I have 100% line of best fit, which means everything is fully explained by the independent variable. On the other side, the worst case, there is just no relationship. So I get a circular blob of these points, and whatever line I put, they all are equally good or equally bad, in which case I'm able to explain nothing. The benefit of doing this is, one, I'm making it transparent because I'm able to say what my independent variable is. I'm able to say what my dependent variable is. I'm able to show it. And to the question that Kapil had asked, what is the time horizon? I can choose a different time horizon. I can choose it longer, choose it shorter. Because if I have longer time horizons, what's going to happen? Some of the economic regimes may change. If I have a shorter time horizon, the economic regime may be the same. So think about it again like food. Or sometimes there are, in crops, you will get slightly higher values because that particular season was a good season. And during periods of drought, some of those food values may drop. But it is those differences that make you understand how food is going to deal or how much food you need to eat to get the level of nutrients that you want. So regression is a standard statistical technique that is used across multiple dimensions. And all that academicians started to say is maybe we should put it to use within the portfolio context. So the first model that actually came out, thanks to the work of Markowitz, Sharp, Lippner, Trainer, so all of them kind of put together something called the capital asset pricing model. The capital asset pricing model, frankly, one of the key outcomes it said is that there is an equity premium, which is effectively the systematic risk that an investor is taking in investing in equity and the premium that the investor expects. Not in a particular company. So if there is a particular company that you're investing in, you're doing two things. You have a systematic risk plus the idiosyncratic risk of that particular company. What does idiosyncratic risk mean? It is the risk of the company. Management may change, the product may not be doing good, or the product may do exceptionally well, new markets may open up for that particular company and not for anybody else. But if you created a portfolio, you could diversify away the idiosyncratic risk, and all that you're left with is the market risk or the risk of equities. And they said that every stock primary driver should be the market. And so the simple approach here is you take the return of the fund, you subtract out a risk-free rate. The risk-free rate was included specifically because an investor always had a choice. Either they could invest in the equity market or they could just give the money away on a risk-free basis so that they are assured of a return. And only a rational investor who feels that the equity risk premium gave him a higher or her a higher return than what was expected from the risk-free would he or she move across to taking equity risk. And so the simple equation really was the excess return of the fund is related to the excess return of the market. So here what I've taken is a market of Nifty 100. Why did I take Nifty 100? Because SEBI has said all large cap companies should be kind of related to the top 100 names within India. So what this now shows me is that the relationship between the two is actually visually pretty clear and looks pretty strong. When I draw a line, the line also looks pretty nice. In the equation, I've got a few notes which I'm just going to quickly go over. There's the first one which says 0.001 with 1 star. The stars reflect a test of significance, and I will talk a bit about that later on. but assume that 3 stars is better than 1 star, which is better than no star. Right? So 3 stars is something that you should be looking for. If it's 1 star, it's like interesting, but not really interesting. The 3 stars actually come up in the second one that says 0.94. What it's effectively telling me is that the market, the Nifty 100, returns of the Nifty 100 are explaining 94% of the fund's returns. 6% is the variable number. That's the variation. And then there's another line at the bottom that says adjusted R square is 0.96. That's basically telling me that the goodness of fit, which varies from 0 to 1, is 0.96, which means this actually explains a lot of the returns. Right? So CAPM was kind of the first thing. And a practical outcome of this is now, rather than me looking at the difference between how the lines have gone between the fund and its benchmark, I'm actually looking for the adjusted R square, how well is the benchmark explaining the returns, and how much of the returns of the fund are being explained by the benchmark. So in this case, 94%. So now the question for me is really, if all that the manager is doing is giving me 6% extra, actually there's not that much, why don't I just buy a low-cost index fund that tracks the Nifty 100? I may be off, but I'm not going to be off by that much. Of course, the market, while it was good, didn't explain everything. So a couple of issues that practitioners and academicians have really wondered about is, one is called size. So what they found historically is that small companies tended to do better than big companies. So that means if you bought a portfolio of small companies, you kind of tended to earn, on average, over long periods of time, you tended to earn higher returns than if you bought large companies. A second one was value. Value is something that has been there now for well over a century. Cheap companies tend to do better than more expensive companies, right? So these two kind of became the size factor and the value factor. And so Fama-French, in their wonderful piece of work, started to include size and value into that regression equation. Now, why the way they chose size and value was using a particular definition. And the particular definition was one where they said it has to be independent of the market. That means if I have a portfolio of companies, any portfolio, there is always going to be market exposure. Why? Because as we've just seen, the market explains a reasonable amount of variation in the fund or stocks returns. So we cannot have something that works that is correlated to this. We've got to find something that is kind of different because we want to find explanation. A simple example is, as practitioners, I'm sure you started, when you evaluate companies, you look at both revenue and gross margin. But for a company, gross margin and revenue are actually very closely related. Right? So if you were to kind of build a financial model for the company, you will tend to use one or the other, because you will not be able to split out what is the difference between revenue and gross margin for the company once you worked out the business model for the company. Right? Because you could say, if I know this is the revenue, my expectation based upon the costs that I've seen, there is a fixed number that will give me the profit margin that I get. So the clever part that Fama-French did was really to find factors which were independent of one another. So they found the value factor, which is small minus big, and value factor, which is high value minus low value, that is cheap stocks minus expensive stocks. So they included that. So now suddenly the regression got a bit more complex. Right? And the complex regression actually looks like a plane. Why? Because we have 3 dimensions. You have the market, you have size, and you have value. And if you kind of draw the same single line that I had drawn, now you kind of have a 3D model, you'll again start to see something similar. You'll see that the principle is exactly the same. You want to minimize the sum of squared errors and draw a line, draw a plane that works across these three dimensions. And as long as you're able to do that, that plane is able to explain the returns very well, you're actually doing a pretty good job. So more complexity, because now you have two additional right-hand side variables, but you're able to isolate the effects a bit better. Now, in this particular case, rather than using the Nifty 100, I've used the factors database that is available. And the factors database has got about 2,500 odd companies which are currently listed in the Indian markets. It has got data for all of them. So the Nifty 100 comes to about 70% of the total market capitalization of the NSE. This market factor actually has pretty much all the companies that are out there. So we've gone from 70% explanation to 100% explanation. We also have size and we have value. And what the same equation comes up and tells me is that the market explains 90% of the ICICI fund. And then there is about 14% coming from size, which means that this is a large cap. So there's a negative sign there. The negative sign meaning if we are doing small minus big, a negative sign will effectively mean big minus small, which means that you are having larger cap companies rather than smaller cap companies sitting within this fund. So what it's saying is that there are two variables now that are helping you explain. The first variable is the market itself, which still occupies a large chunk. And then there is a secondary variable called size, which is large cap, that is now explaining some more. The adjusted R square in this case is 94, which is also a really good number. So it's a high explanation. And now it is helping me starting to look a bit closer at what are the drivers of return. So now when I go and talk to the fund manager, and the fund manager gives me a long story about, I've got these 5 companies that I've taken based upon value. I go and look at this and say, you know what, historically, you've not shown me any of this equation or any of this relationship. I'm sure you're doing a great job in terms of choosing companies that are of value, but as a proportion of your return, they're very small. So while please keep up the good work, value doesn't come out if I look at it purely from a returns point of view. Right? So now you're starting to get a bit more insight into how returns are being decomposed. Remember this whole thing about taking food and saying how much is going to be looked at from protein, how much you're getting from fat, etc. So it is that clarity that I'm getting in terms of what is driving returns from the portfolio that the mutual fund has that's going to help inform my decision. Neeraj asked an excellent question. Why is the adjusted R square decline? Excellent question. Because adjusted R squares, remember what we have done. In the case of Nifty 100, it is just the large cap companies. So by taking only the large cap companies, there should be a higher explanation because remember, the fund is a large cap fund. What have we done here in the second equation? We've taken 2,500 companies and that becomes our market factor. So we've introduced a lot larger variation because we've taken away that one piece of information that you already knew. So let's say I'm a Martian who have coming to Earth right now. I don't know what large cap means. You give me Nifty 100 and then I'm trying to figure out, but maybe you kind of pushed myself, you biased me by using Nifty 100. Tell me what it is against the overall market, because if academic theory is right, this is the market factor. I should be diversified across the market. So then when I take the diversified across the market, the amount explained has gone down from 0.94 to 0.90. And then the rest of it is starting to come out from size. Between 94 and 96, do I get worried? Actually, as a practitioner, frankly, anything about 85 is actually not a bad number. So remember, these are statistical numbers. So if I have more data, then the numbers get a bit better. If I have less data, the numbers can be a bit, there's always a case of sample error. So should I be very, very specific in terms of using these numbers? May not be, except if I have long histories. Then I should be very specific. But between 94 and 95, 94 and 90, for me, as a practitioner, I would not say that that's that much of a difference. It'll affect the way I think about the fund and how I react to what the fund manager is telling me as to their strategy. Gagan asks the negative SNL, small minus large. So Gagan, one of the problems of regression analysis is the coefficients are not necessarily intuitive. So the construction of small minus big is that you take a portfolio of small companies and you subtract out the returns that they get from a portfolio of large companies. So effectively what you're left with is the size. It's only the size that is going to make a difference, because from a market point of view, you kind of wiped out the impact of the market because you're taking portfolios. Now, if it's a negative side, if it's a positive side, that means let's say you had a coefficient that is plus, you're effectively saying size minus large, small minus large is a positive number, right? So therefore, that means intuitively, this is a small cap portfolio, tilted portfolio. If you flip it around, it becomes a large cap tilted portfolio. Hopefully that has helped, Gagan. We will actually cover this in some of the funds, so you'll actually get a sense of how it works. The next piece that came up is there were other factors that people had. So Fama-French then added, based upon research that other people had done, they added something called a profitability factor. In this case, it means firms that have robust operating profitability tend to do better than firms that have weak operating profitability. They added something called the investment factor, that is things that are firms that invest conservatively tend to do better than those that invest aggressively. And finally, there was this huge thing called momentum. This was based off a lot of work and became really popular after Jagdish and Titman came out with their paper in '93. That basically said that firms that tended to do better in the recent past continue to perform well in the recent future. And firms that did poorly in the recent past continue to do poorly in the recent future. So now suddenly, instead of having 3, you have 5 plus 1. So you have 6. So suddenly your dimensionality is a bit larger. If we did the same fund again on these 6 dimensions, more complex, but at the same time, it gives you a slightly more flavor of what a normal fund manager will talk about. Fund manager talks about quality, fund manager talks about value, fund manager talks about momentum, right? So these are common words that keep getting used. Now, if the fund manager comes and tells me, Rajan, I have something that is high momentum, my expectation is to see a significant positive WMA, winner minus loser coefficient when I do the regression. If I don't see that, then yes, the person may be following the principles, but the food that he's cooked doesn't have the value. Something that he's doing in the cooking is not helping me. So sometimes to take stories that fund managers make and say, translate that into scientific value out of what the food they create, i.e. the portfolio, it is well worth to have a discussion, because then it's an objective conversation. Yeah, you're doing all of that is very nice. How come I don't see this? And a fund manager should be able to explain that to you. Now, in this particular case, we have the market factor, which is still the largest. We have the size factor, which is still broadly the same as the 3-factor one that we looked at. It's an interesting. We've got a bit of value coming up. We've got a bit of robust companies coming up. So the fund manager is starting to do something. We're able to see some of these signs starting to come through from the fund manager's point of view. Right? So each of the coefficients here represents sensitivity of the fund's returns to that particular factor. If I get something like this that only shows me everything is market factor, I might as well just buy a market index. If something that shows me it is a market factor, but it is effectively a large cap company, then I can buy a large cap index fund. If I'm getting something that shows market factor and exclusively, let's say, momentum, then I start to look at what momentum alternatives do I have? Can I find an index that gives me the same effect? Right? Okay, let me take up 2 more questions out here, or 3 more questions. Should small cap or large cap basket be equal weighted? I'll come to that. This one from an anonymous attendee. I'm going to come to that when we talk about the factor construction. So please hold on for a couple of minutes. Gaurav asks, we generally say in multiple regressions, if adjusted R square is increasing, then it makes a point to add a new variable. Does that mean we go with CAPM in the current example, or try to take a model which help assessment of the fund manager more better? Gaurav, excellent question. In my mind, I think you have tools that fit purpose. Sometimes CAPM works, sometimes a more complex model works. It all depends on what you're using. If I'm trying to understand fund manager behavior, especially over time, I would tend to go down slightly more variables that I know kind of is fair to the fund manager, because the fund manager does a lot of hard work and they actually choose stocks with a particular purpose. And all I'm trying to do is to see if the returns are showing me what the fund manager is doing. So I would say sometimes you can use CAPM and be happy. Other times you may want to choose something else. What happens to liquidity? Do we know the effect? Again, Ramaswamy, great question. There is a liquidity factor. The Fama-French guys, both of them didn't think that the liquidity factor was too important. Within the Indian context, the liquidity factor also, I think, makes a big difference. But you'll find that the Indian market is extremely top-heavy, which means that the top 100, maybe the top 200 companies effectively have most of the liquidity, and everything else starts to drop down. I think there are practical implications to that, but in terms of trying to understand drivers of return, I would say the liquidity effect is more a slippage and a drag on returns. But for you to be able to understand the drivers of return, I think it is still okay. I think you'll still be able to use the analysis from a reasonable point of view. Utsav Vijay asked for fixed income. Great questions, something that we'll address to it in the very end. All right. So one of the, while the regression looks all very good, now I'm going to spend a bit of time on what all to worry about. So the first one that I would worry about is a residual analysis. At the end of the regression, there's always going to be errors. So as we have errors, you want to check what the errors are like. So there are a few things that one has to worry about. One is a fancy word called heteroscedasticity. It means that the residuals are slowly increasing in time, decreasing in time, or they're not acting random. If that is the case, that means the regression may be okay, but actually the results, you should not rely on the results. The second piece is autocorrelation. Does the value that you're using today, is it dependent on the value that you had used yesterday? Most prices are autocorrelated. And then finally, are there 1 or 2 big moves that have happened? So for instance, in terms of outliers, COVID, when we had COVID or the global financial crisis, there were a small period, few months where things were all over the place. And then you have to be a bit careful about how you interpret the regression results. So doing residual analysis starts to help us understand this. In this particular chart, autocorrelation is kind of clear because the variables, the errors are not completely random. There seems to be some kind of a sine curve here. It goes up, comes down, goes up, comes down in a reasonably visual pattern. So therefore, one has to be thoughtful about how we start to use these results. I want to explain kind of 2 or 3 really important things as one thinks about these regressions. Because the easiest stuff is, let me throw everything on the right-hand side, and then my regression should explain. So the first one I want to talk about is multicollinearity. Regression assumes that the right-hand side variables are independent of each other. What people tend to do is actually have the right-hand side variables not necessarily independent of each other. Practically, it is very difficult to make it independent of each other. But I go back to the earlier point I made. You're trying to build a model which has got sales and or revenue and margin. If you use that on the right-hand side, you're going to find two variables that have got a high correlation between them. Those are called multicollinear variables. And those variables, if you have that effect, they actually distort the coefficients. The overall regression may still be okay, but the explanatory power in terms of distinguishing between what variable A does and variable B does is going to be very difficult. And it is very difficult to solve this problem. So you'll have to either drop variables, combine variables, or use a different regression technique. And there are a few regression techniques that have kind of worked out. The second one I want to talk about was autocorrelation, just what we talked about. Autocorrelation is inherent within most time series of prices. And so one has to be careful about how you use it. Here, the coefficients may largely be okay. It is the way the errors are created that are likely to be incorrect. So the test that we use to say that this is a significant variable or not significant variable, that has to change. Now, this one is fairly easy to do. There are some kind of techniques that have been well tested and used. So autocorrelation can be handled in a slightly more easier manner than multicollinearity. The reason why I bring this up is you'll find a lot of equations amongst the popular commentators where they use the style indices that Nifty or somebody else produces as right-hand side variables, and they use it cleanly. And as I'll show you, these are highly correlated variables, and therefore the outcomes that you get are actually question marks. Autocorrelation, you will get the same results, but the statistics that they use to say this is significant or not is the one that we should be looking at. The good thing about the regression analysis is it gives you a test of significance. It says that I'm fairly sure that there is a null hypothesis that is being met. The null hypothesis in regressions are all the coefficients are 0. So even if you have a value of 0.14, the null hypothesis is that is a statistical issue. The actual underlying value is 0 is what the test of significance says. And you have a few tests, you have a few levels of confidence. For most quantitative finance stuff, you're looking at a 5% confidence level. So that's 95%. You want to be sure that this is not, it rejects the null hypothesis. That means it is not 0. That's how much confidence you want to have. And usually that value comes to about 2. At 95%, you're pretty okay if it is 2. It's 1.96 to be precise, but it's 2. Because of autocorrelation and other things, there have been studies that start to look for these at 3.5 or 4, which kind of increase the confidence level that we have in terms of how statistics work. So all of a sudden, from going from pure opinion, which was based upon an analysis of a line that is separate, and the holdings, we now have a much more precise measure. The precise measure is saying, I've done a test based upon the returns that you've given me. Here's how I've decomposed it, and here is my confidence of that decomposition. I want to spend a couple of minutes around the factors, and I know people have asked about how these factors are constructed. So the first part is there is a cutoff level. So first there is the universe. The universe is effectively the end. In the case of the data set that I use, it is 2,500 odd companies at this point in time across NSE and BSE. The first cut is on size. 90% market capitalization and above are considered big. Everything else is considered small. Approximately about 350 companies come into big. The rest of them are small. Within that, we have metrics that make up how do we choose what is value. So we have something called book to market. These book to markets come out every year. They're published in March. We take that March number and then we divide the entire population based upon the big size metric of 30 percentile and 70 percentile. That means I take all the big companies, I look at the 30th percentile value for book to market and the 70th percentile value for book to market. And that then becomes the cutoff. From there, I create 6 portfolios. The 6 portfolios are big and small being the first category. And within the value category, I create low value, neutral value, and high value. Low value are things that are 30% and below. High value are things that are 70% and above. And everything in the middle are neutral. Using that, I now can create the size factor, which is effectively the small high plus the big high, the returns that I get every month of these. And I subtract out from that the small low and the big low. By doing this, I've addressed hopefully the question, which is the market is taken out. So the market factor is actually, these are market weighted, so they're not equal weighted. So because they're market weighted, the entire market effect is taken away. The database that I produce actually also has equal weighted. There, when you use the equal weighted, these are not strictly market neutral. There is some market that still comes in. And so when you use those numbers, you have to be a bit careful. We do the same thing for all the other factors, including momentum. For size, it's actually a bit more complex because there what we have to now take out is not only the market factor, but you also have to take out the value factor, the operating profitability factor, and the investment factor. So it's an average of 3 small minus big portfolios. And this is the, in my mind, one of the best innovations that Fama-French have done. And I think one of the reasons why Fama-French should have had the Nobel Prize which they won. Okay, a couple of questions as we go through. Yogesh asks, sector and industry membership as an independent variable. Bara uses absolutely right. Bara uses a much more detailed industry dummy variable model. The industrial dummy variable model, and while I think it's a really good model, I think one of the things that you got to really start to think about is how are these industries classified. So, for instance, a few years ago, the telecommunication industry in the US was kind of split out, and they moved companies from A to B, which changed returns significantly, which means all the earlier tests have to be redone. So when you use sectors, I would say just be careful about how you use the sectors and make sure you keep looking at it on a regular basis. Shouldn't book to market be lagged by 2 months? Yogesh asks, as the March data is known only. Again, great question. So the way I look at it is, as of March, the only time that it actually gets constructed is as of September. So this follows Fama-French's methodology of 6 months, so that the entire information is spread out across the market. So it is not lagged by 2 months. In that way, the portfolio is constructed 6 months later. Why is momentum left out in calculating the Anish asks a really superb question. So Anish, you've given half the answer yourself, which is that Fama-French still don't recognize momentum as a factor. But more importantly, the other factors are annual factors. So they're constructed, portfolio are constructed annually. Momentum portfolios are constructed monthly. So actually there is a small difference. Secondly, momentum portfolios, if you construct it for over 1 year, they tend to lose the momentum effect. So that really doesn't work out very well. There are some interesting nuances about trying to include momentum into size, but and there's a fair amount of discussion amongst practitioners as to why this is important. But I think amongst the academic communities, the size factor is one where academics feel that there is still evidence for it. Practitioners have ignored it completely because ever since it was actually published in '93, size factor really hasn't worked out very well. If you take the US, it's been the large cap companies that have grown significantly. But academics say that 20 years is like nothing. Practitioner says 20 years, everything. So I guess it's a bit of how people perceive the length of time. Again, I don't think it's there's a lot of debate going on there, but I'm not going to spend too much time on that within this particular session. Harsh asked, what is a more reliable model, FF5 or Cathart? By the way, Cathart, all that Cathart did was took FF3 and added the Fama-French 3 and added momentum. Again, Fama-French will show you evidence that actually momentum is subsumed within their factor set. So I would say depends more on how emotionally connected you are to momentum or not. Can you re-explain the market factor? So the market factor is really what is the return of the market. So if you take all companies, market weight them, and you'll get a return, that is effectively the market factor. The piece that you want to take out from them is take out from it is the risk-free rate. And so if you take out the risk-free rate, you get the market factor. So compute market weight returns for all stocks in the universe, subtract out the risk-free rate, and that's the market factor. Is there a study where they took RM, the market factor, and do a regression on that? Absolutely. So I don't know who asked this question, but it's a great question. Fama-French have done it. I've done something similar for India, so I actually show you if you drop one of the factors, what is the residual explanation of the others. If you want to read it, well worth reading. But I would say then you need to know a bit of regression as well as a bit of finance theory. Please explain the B to M, that is book to market. So normally you'll find price to book is what people talk about. Book to market is just the reverse. It is effectively book to price. How do you take weights in six portfolios? So market cap is the traditional academic version. There's also an equal weight. Most of the indices, style indices use factor tilts. So different people use very, very different approaches. Kaustubh asks, to what extent the analysis discussed here can be codified and learned by a machine? Excellent question. I will pass on that for the time being. Maybe we'll talk about that at the very end. Yogesh asked, the entire NASDAQ return for the last 10 years have been driven by mega caps. Absolutely right. So again, you can actually do that. Yogesh, it's very, very straightforward. You can take the NASDAQ returns. You have the Fama-French factors on the excellent French data library. Well worth doing this exercise. It'll be a useful approach. Final question that I'm going to pick up here is explain CMA. So CMA is conservative minus aggressive. So the idea here is the investment approach of firms is an important driver, or one of the important drivers of returns. Conservative firms that conserve capital tend to do better than aggressive firms that give capital away or invest capital away in multiple projects. That's what conservative minus aggressive is. Okay. In the interest of time, I'm just going to move on. So where do you get data? There's a whole bunch of data available free for those people who like it free. For fund navs, you can go to Amphi, you can go to the fund houses. For those who use paid sources, there's a whole bunch of them. Factor libraries, there are actually multiple within India. The one that I put out, and I'll just kind of share the screen for that. If you just give me a minute. If you just give me a minute, I'll share the screen for that particular. So this is a data library which follows pretty much the French data library format. It has got a whole bunch of returns that you can pull down. Fama-French 3 plus momentum, 5 plus momentum, all the various sorts. Both the 2x3 is the univariate. Univariate means just deciles that we create, and 5x5 portfolio. So there's a whole bunch of information out here that you can potentially look at. There's also the IIMA data set. It is updated not necessarily every month. Mine, I try to update it every month. So far, I've done it. IIMA data set is kind of slightly more irregular. It comes, I think, once every 3 months, once every 6 months. There is a difference, by the way, between the way IIMA constructs its factors and the way I've constructed. My construction follows Fama-French to the T. IIMA uses a slightly different methodology. Can French data library for international outstanding. For those of you who want to look at it for specific countries, please go to the EQR website. They have an excellent data library too. They're all slightly 1 month, 2 months kind of delayed, but still worth it. For those of you who have paid, Bara was already mentioned, there's Bloomberg, there's Refinitiv, there's a whole bunch of paid data sets that you get. Key parts to really understand is one, make sure that the data is comprehensive and complete. Make sure you understand how the data sets are being created, because those are really important to understand. You use price returns or total returns, common question. I tend to use total returns because I think that gives us the total value. But then, you may not necessarily get total returns all the time. You may just get price returns. How do you deal with funds that pay out distributions? I do a simple trick on that, which is I just use the growth share class, because effectively there will be a small slippage, but effectively I should get the total returns coming from that underlying share class. Risk-free rates do matter. Please don't ignore them. It's a shortcut to ignore them. I think it's in most cases it'll be fine, but risk-free rates are available today, and it's well worth using them. Like I say, either you can go to the IIMA data set, you can go to my data set, or you can compute the risk-free rates yourself. It doesn't make too much of a difference. It's not that complicated. Finally, the longer the data series, the better. Most people look at 3 years and say, look, this is how it is. All I would submit to you is 3 years is like a blink of an eye. The longer you get, the better it is. Okay. Then just quickly kind of moving on. Holdings based with returns based. Holdings based is somebody telling you a story of what they're trying to do. Returns based is you analyzing the food and trying to tell what they have done. I think both make a lot of sense. I would not use one over the other. I think both going together is well worth it. The regression analysis is an extremely powerful tool, important for us to learn it. And if you understand where it can go wrong, you should check for where it can go wrong. Okay, let me jump into the actual looking at it first from an Excel point of view. There were a few questions which I think I will cover part of this. The one question that I'm going to leave to the end is the debt fund, because that comes back to the fixed income factors. So please don't use equity factors for debt funds. Okay, that's really important. Some of the other stuff, Ramaswamy asked, banking companies included in the companies. Yes, at least in my data set. How do you respond to critics like factor analysis? Excellent critics, all of them have they have a good argument, but with all due respect to them, I think there is a role that factors have. And it's not true that out of sample performance is indistinguishable from noise. I would beg to disagree. I think there's enough data out there. If the asset managers extended universe is say top 750 companies, should you use 750? The problem with factors is that concentrated portfolios are going to give you idiosyncratic risk. So if you were to take 750 companies, and let's say you were trying to do some tests of significance and tests of analysis on that, and let's say you want to create a 5x5 portfolio, you're going to have portfolios that are so small. In fact, there'll be some portfolios where there's no stocks in there. And so there is, on the one hand, the practical usage, and then there is the academic usage. The academic usage, or at least the way I look at it from a practitioner, is I'm just trying to understand what the guy has done. Do I really worry whether there's liquidity or not? Actually, I don't, because as far as I'm concerned, that guy is telling me a story. The fund manager is telling me a story that she's doing ABC. I'm just trying to take a baseline to say, have you done ABC? That's it. For those of you who are trying to build factor portfolios for alpha, God bless you. That's where you need a lot more of these very specific practical concerns. But that's not what our objective today is. Are these values of data absolute or percentage? I'm sorry, Monica, I don't fully understand that question. The numbers that you see these are percentage returns for the month for that portfolio. Right? How does a small investor use this data to construct his portfolio? Separate question on portfolio construction. Based on your various studies, research, can you share your comments on various factors? Let's come back to that. Just hold off on that question. Maybe we'll come back to that towards the very end. how to analyze these factors as a fund investor. Excellent. Suraj, you asked an excellent question, and it's one of the things that we're going to do. All right. So now all I've done is in this particular Excel, I first downloaded from the website. I've downloaded this the factor returns. I've downloaded the 5 factors plus the momentum factor. And as you can see, this has got a months over here, and for here, each of the portfolio returns. So WML is the factor return of minus 0.46%. That was the return it had, that portfolio had for 430. The way WML was constructed, I've shared with you or I've just talked to you about in that other chart. RF is the risk-free and market is the total market return, and that effectively is going to be this 0.6 market minus risk-free is what will give us the market factor. All right. So the first thing I want to talk about was factor correlation, because remember what we said, it's really important for us to have kind of independent right-hand side variables. The one variable that is not is RMW and HML are highly correlated. 0.72 is, I would say, on the what I would call a strong correlation. So other than that, everything else is actually pretty good. So therefore, the coefficients that we get, the one thing that we got to worry about is if I have HML and RMW, I have to kind of figure out what is the fund manager trying to tell me and what is being seen. But other than that, actually, it works pretty well. I want to show you on the flip side what are tended to use by popular commentators. Here, almost everything is above 0.72. Right? These are highly correlated. And then if you take these highly correlated right-hand side variables and then say my coefficients are looking like this, you're generally likely to be wrong. So therefore, be very careful about using style indices to kind of do your factor analysis, because it's not factor analysis. Right? The second, the next slide, the next sheet is really all I've taken is I've got down the NAVs for these funds. I've taken a range of funds, Prudential Technology Fund. Somebody asked for a defense fund, but I've taken a technology fund. There's a multi-cap, a dividend yield, emerging equity, blue chip, large and mid cap, flexi cap, and small cap, clearly to reflect the various AMFI fund categorizations, right? From here, I calculate returns. Quite simple, nothing much to do. Then I subtract out from there, I subtract out risk-free rates. I got the risk-free rates from the factor data set. So now all I've done is subtracted it out. And here I've kind of got my base data. Every month time series for each of the funds, as well as the factors over here. And then the only thing that I do is a regression. And for all of those who don't know how to do a regression, you go into tools, you do data analysis, and then very nicely what it pops up is a regression, right? And if you just click through, you'll get a whole bunch of stuff. But your outcomes are now going to start looking like this. So the ICICI blue chip in our factor regression for this period is what we've already seen. You know, a reasonably good R square. I've highlighted the one with the key values. I've looked at the market factor. Remember when we talked about T statistics, we talked about 2 being a kind of a baseline, but you know, if you look at it, 3.5, 4, those are pretty good numbers. So I've highlighted that the market factor is extremely strong. So therefore, a large part of the returns of the fund are being explained by the market. And then size. Once again, this is a negative value. Negative value for size will mean that it is large cap. If you have a negative value for HML, it means that it is going to be an expensive company. If you have a negative value for robust minus weak, it means that the tilt is towards weak companies, which means companies with poor operating profitability relative to those in the market on a cross section every month. CMA, if you have a negative value, means that the person is investing in aggressive companies. So if you were to take an aggressive company tilt, a growth company tilt, and a small size tilt, it means that the person is investing in startup, early stage, aggressively growing companies, right? So therefore, you would expect that the market beta to also be high. So all of these in some way are, kind of interrelated as well. But the clear thing is ICICI blue chip, large cap company, negative SMB. I want you to remember that because now we're going to Mire, which is a large and mid cap company. Now you'll find that SMB now suddenly has turned positive, right? It's turned positive, which means that it is no longer skewed towards the right to large cap, but it is more towards large and mid cap. Remember what I said from the data set that I make, it's about 350 odd companies that we have. So in this particular case, Mire would be looking at investing in companies below the top 100. And so the tilt will slowly start to shift towards the smaller caps. The small cap definition that I have is very different from the large, mid, and small cap companies definition that SEBI has. But here again, adjusted R square is good, 92%. Still a pretty strong exposure to market. But the interesting thing here is the T-stat for the intercept. Now, the T-stat for the intercept is effectively saying this person is outperforming the factor model that we've got trying to explain. It means that this manager is actually doing something pretty interesting. I'm able to get an outperformance over the factor model. And this outperformance is actually significant. So I may want to take a slightly longer tenor. I may want to analyze it a bit more because this could be a very interesting fund to an investor. Right? Then we go down to the next, emerging equity. Emerging equity, again, if you look at the SMB coefficient, that is even higher. It's now gone to 0.38. The adjusted R square, 90% still pretty high, starting to get a bit weaker, which means idiosyncratic risk is starting to increase here as people are starting to move down. So some of the comments that you made about liquidity, all of those are starting to come through in the way I start to analyze funds or how I start to explain returns of funds. Here too, not quite 3, but there seems to be a positive alpha. Not quite 3. So maybe there's weak alpha, maybe something more for us to look at again. But so far, I guess one thing is very clear. SEBI's guidelines of market cap are being clearly followed. Because for all of them, you can see a strong market exposure and size exposure. In the Nippon India small cap, you'll see that the SMB has gone up to 0.7, much higher. Right? And still strongly being explained by the market. These 4 funds raises, for me, an interesting question. Has SEBI constrained, or the SEBI guidelines constrained fund managers from actually choosing other factors? Or have they put so much emphasis on the SEBI guidelines that they have forgotten how to choose other stocks which are display different factors? Is there a source of diversification that or a differentiation that a fund manager could do by saying, look, I'm actually going to pick up, I'm just making this up, value stocks. So I'm going to be a large cap value play in India. In which case I would expect to see a much more significant value component or value effect starting to come through. Let's look at Parag Parekh's Flexi Fund, which is actually a really interesting one. First thing you notice, extremely poor or much lower R square. Question you ask is, what happened now suddenly? As you go back and look at the next piece, the market factor is also really low, 0.7. Then you go back and look at the holdings analysis and you suddenly realize that Parag Parekh has got a reasonable exposure to international equity. So our factor model is kind of incomplete. There is a whole piece that is missing, which is international factor. I put international factor in here and all of a sudden it looks very different. So my factor analysis has given me a flag that tells me to look deeper from a holdings analysis point of view. I'll look at that a bit more in one other fund in a short while. The Nippon Multicap. Nippon Multicap is interesting because now the fund manager has much more flexibility as compared to all the others in terms of what the fund manager could choose. But here's the fund manager, or at least in the period that we looked at, who's still chosen to remain within the market cap and size cap portfolios or constraints, right? So the interesting thing that at least I've noticed is fund managers seem to be not picking up the factors exposure that they claim to pick up as part of their marketing documentation. UTI dividends. Now, dividends is an extremely interesting one, right? Because dividends, you expect that to be from stable companies, companies that are not growing that much. They have a lot of cash flow that they're distributing. And guess what our factor analysis shows? Not a bad R square. Again, reasonable market factor. From a size point of view, it is negative, but the T statistic is not very high. So therefore, not really moving the needle. But the interesting part is really this. RMW and CMA, they are investing in robust companies that are conservative, which is what you would expect a dividend company to do, right? So here you got, again, statistically, we are able to show that a dividend yield player, a mutual fund, is actually delivering to us what we would like to see happen. Finally, I wanted to show the technology fund, ICICI approved technology fund, because that has got an even this is the lowest R square amongst the sample of funds that we've looked at, right? 0.41. And then when I go back here on the right-hand side, I've actually got the actual fund holdings. You'll see Infi and Tata Consulting, TCS, they are basically 37% of the fund, extremely concentrated. Right? So all of a sudden here you have idiosyncratic risk starting to be seen by your holdings analysis, which is exactly being mirrored within the factor-based analysis. Factor-based analysis is actually really simple. All that I need is the NAVs, and I need a factor data set. Once I have that, I have a really quick way and a low-cost way of trying to look at a fund. And once I know that fund, then I can go back and do the much more detailed holding analysis, and both of them would kind of work together. That was kind of the Excel piece. By the way, all of this kind of works through in the same way. You just have to go and look at data analysis, and then run the regression, and this is the output that you get. Any questions on this so far? Okay, let me, Kapil asks, see, even if we are able to draw a correlation level between markets and factors, then a very high chance that by next year, this correlation, what to do with this data practically. So Kapil, here's my kind of small disagreement with you. Actually, there will be a change, but from a statistics point of view, these have tended to be, over longer periods of time, they've tended to be very small ranges. If you use something short, I think you're in trouble, because those do vary quite a lot. But over long periods of time, these things have been reasonably stable. And that's the reason why they are called factors. If they were not called, if they were more kind of idiosyncratic volatility or idiosyncratic reasons why returns change, they would never get captured as factors because of the statistical tools that one uses. So my only pushback to you is, yes, correlations will change, but don't look at short-term correlations. You've got to really look at this over longer periods. So my suggestion to you would be, take a data set, run correlations over 1 month, over 6 months, run correlations over 1 year, roll them over, and then run correlation over 5 or 10 years. And you'll start to see that the correlations start to stabilize as you get longer and longer. What are the max risks to a portfolio built on factors? I'm sorry, Kapil, I don't fully understand the question here, because the one thing that I want to say is that factors do have their own idiosyncratic risks. They do have their own risks. It's not that they are risk-free. As they say, it is important for you to, the only reason why you earn a premium is because you're willing to take a risk, which means that factors will have bad times. You can diversify between factors, just like you can diversify between market cap, or you can diversify between sectors. And that will kind of minimize some of the drawdowns, but the risks are always there. And you'll just have to understand each of the factor drivers as to why those factors are there before you fully understand the risks. And by the way, risks within factors, so momentum factor will have a different set of risks than, let's say, a conservative portfolio. Any data on how factor portfolios, companies with active funds, or even Madhur, yes, there are. I've written a few papers on this that looks at active funds as well as pure indexes with Harish Krishnan. I've written the one on indices from an India context. So that's actually kind of available. Kapil, you also asked, would you suggest building an accumulation stage pension portfolio on factors? That one actually depends upon you more than anything else. If you believe in the factor process, then there is enough evidence to say, or enough studies to show that you can build a pension portfolio around factors. By the way, an excellent book to read is Investing Amid Low Expected Returns by Antti Ilmanen, who actually talks about style-based portfolio construction. Gaurav asked, when do we take factors which explain fund manager style more? When we take factors which explain fund manager style more, won't that create a risk of model overfitting, not giving good? Absolutely not. So Gaurav, I would again say absolutely not. All that we are trying to do here is to say, fund manager, you say all the following things. Let me try and see how you're actually doing. So if you look at it, the fund manager generates returns from 3 areas: stock selection, asset allocation, or allocation within the stocks that they've taken, and timing. Factors are giving you baseline portfolios of selected, allocated, and timed stocks. Why? The selection is big or small. You've taken out the market risk. It's across all companies. Allocation, market cap, and timing, annual. So that is the baseline. So now whatever the fund manager does over or below, you have a baseline to look at. So actually, I think that it is a stronger way to appreciate what the fund manager has done. Because I do think when you look at this and you start asking questions with the fund manager, you get a much better understanding of why the fund manager has done what he's done. Some of them are market timers, and they're great market timers. Many of them do a great job in stock selection. And there are a few of them who do a great job in allocation. It's rare to have all 3 of them coming together under one fund house, fund manager. So therefore, I think the factor analysis helps you have a better conversation, a more detailed conversation, and a less personal conversation with a fund manager or a wealth manager. Anonymous asks, the reason I asked, this is about the university use, does the 2000 stock universe portfolio not get biased for microcap? Again, excellent question. Let me repeat the question. Does the 2000 stock universe not get a bias from microcaps contributing a significant portion of factor returns, despite securities not being realistically investable? Absolutely not. Why? The break points are taken from large caps. So the small cap issue is not, micro cap issue is not there. By the way, that's the difference between the IIMA data set and the data set that I put out. So first, it depends on where the breakpoint comes in. Second, because you're doing market cap weighted means that the micro caps have a very small component in any case. So that the outlier micro cap, one way or the other, is going to have a tiny effect on that particular portfolio. And then when you subtract the 2 portfolios out, the long versus the short, that gets even more minimized. So the reality is, I think there's more benefit than harm from what you're saying. Can you tell us what is the market you've used? This is so the universe I get is from DataStream. It's called the World Scope India list of companies that has since 2005, it has got about just under 5,000 companies, both dead and alive. And I have data for all of that. So this is pretty much everything that is kind of available other than me going to NSE and BSE and asking them for a full data set. Okay, Python, we're just coming to that. So let me just go across to the Python piece, guys. So I'm assuming there are quite a few of you who've used Python, and so it's something that we can kind of bring up. So here what I've done is I've used the Aditya Birla Quant mutual fund, the Quant NFO's data set, which they have so kindly provided on their website. So the first piece, the first piece is really around, I import a bunch of libraries, pandas, requests and bytes IO are primarily for to communicate with Aditya Birla's website. Stats models, this is what I use for my regression. India Factor Library is a small little library that I've written. It's available in the public domain. So if you go to PyPy, you should be able to download it. And it allows you to download data from the factor data set. So this is the construction for the factor data set. Just initialize the library and then call. There's a whole bunch of stuff that you get. And here's pretty much the data set that we've got from the library. The factor correlations, again, just wanted to show you, this is now for the whole period, other than RMW and HML, actually, still the factor correlations remain reasonably tight. The next piece, actually, I get the data from Aditya Birla, and this is what Aditya Birla looks like. So from 2012, they begin, and it works all the way up, all the way through until, I think, earlier this year. I calculate the monthly returns. I subtract out the risk-free rates. So this is the monthly returns of the Aditya Birla Quant Fund backtest, and this is the excess returns of the Quant Fund backtest. I add them up together just like the Excel sheet. So all that I'm doing is following the Excel sheet logical process. Get the factors, get the fund, get the excess returns, pull them all together. And so here is my final data set. Right? So this is the dependent variable. All of these are the independent variables, kind of pretty straightforward. And then when I run the regression, here's what the regression looks like. We have a 90%, 88% R square, again, pretty good. I'm not going to go through the rest of the stuff because all of this is really useful information, but I'm just going to show you what we talked about. First was the intercept, 0.0031, but with a t-stat that is not significant as far as we are concerned. Assume that we take a t-value of 3. The market factor, this is a slightly higher beta fund or a beta backtest is what is coming out. From a size, again, this is a significant variable. The size is again more tilted towards the mid cap. And then it has got momentum. So the one thing that we haven't seen anybody else do, but we are seeing over here is that it has a clear momentum exposure. And it's a positive momentum exposure. So this particular quant fund, if I'm going to have a conversation about trying to invest, is please talk to me about how you get the momentum area, how do you get the momentum factor, how do you select the momentum stocks, how do you rebalance, what is your universe? All of that will start to come around using this information. Right. Ramaswamy, I'll just talk about the errors. Okay, just a couple of things. Why go with monthly data rather than daily data? So Rajan, great question. I actually think it's a style point of view. I don't think there is too much of a difference. I tend to use monthly because as an investor, I don't trade every day. So when I'm looking at this, I want to have, I don't mind small variations that happen during the day or within a month because it doesn't make a difference from my investing style. However, if you are much more a short-term focused person, maybe the daily process is a bit better. Daily factors are much more difficult to get because it basically means a lot more data and a lot more computation. So from an Indian context, I think actually most contexts, using a monthly data set for an investor like me to look for explanation of returns actually works pretty well. What happens if international stocks are included? So if international stocks are included, I have to add into this an international factor. So somehow I have to get a variable that shows me what an international index is doing. I have to subtract out from that international index the market correlation it will have with the Indian market. So that is something that again requires a bit of care, and not necessarily for this particular session, but it's quite easy to add an international market into this analysis. What are the errors? So Ramaswamy, the first one I'm going to check is the multicollinearity. So that's the first check that I tend to do. In the case of stats models, in fact, most libraries will have a variance inflation factor. And all that you do is you take your right-hand side variables, look at the variance inflation factors, and if they're below 5, it's actually not a bad thing. You don't have to get too excited about it. If it is between 5 and 10, I think you should be a bit careful. If it is over 10, you definitely have a problem. So be careful about how WIFs look when you think about doing regressions with multiple variables. Detecting errors, again, stats model has a very, very simple process of plotting the residuals. I showed that to you in the presentation as well. But here's how the residuals look. And really what you want to kind of look at here is to say, okay, is this random or not? If it is not random, if there's certain patterns happening, then you have to go and dig a bit more. If you remember those style indices, I've got those style indices for Nifty 500, that I showed on the Excel sheet. And when I look at the correlations, you remember I showed you the correlations, these are all very high. And look at the WIFs here. And the WIFs are extremely high. So then you can say, Rajan, but you know what, Nifty 500, Nifty 200, let's drop one. Fair enough, I dropped Nifty 500, and still I have WIFs that are too high. So using this as a model to explain regression is actually a bit of a challenge. Right, so the Python pieces are actually pretty straightforward. If for those of you who want to use Python, it's kind of pretty simple to use. I finally wanted to go across and show you something. There's an app called Qfinr, which I'm involved in. Here you can look at funds, or you can put in your own series of returns. And what it does is it actually creates a graphic for you. This graphic is slightly more intuitive. It does a bit more than just a simple regression. But here I take the same ICICI blue chip fund, and basically what it tells me is not very different from what our regression showed, except this has got a slightly more nuanced view. The more nuanced view is that it's market beta. It is slightly more towards the large cap. It does have quality. It does show some effort of the fund manager trying to choose quality, and some effort of the fund manager trying to choose value. The difference between what you saw in the regression and what you're seeing here is, here we actually compare funds across the entire universe of funds. We kind of look at what fund managers are doing and then give them a score based upon the various regressions that we do. We do regressions, not only the simple regression that I showed to you, but we also do just long-only regression, constraint regressions, and use all that information to pull this kind of graphic together. So while we kind of reduce the complexity in the front, we actually increase the complexity at the back. So it's a bit of mix and match. Another thing that we do, and all that you got to do there, is go to a factor and style analyzer of the tool, type in the name that you want, and take it forward. Here what I've done is I've taken 3 funds. So we have our HDFC, Kotak, and ICICI blue chip, and I've put them and said, please compare these funds for me. When it compares these funds for me, one of the tabs that we have is show me the factors, and here it shows you for 3 large cap funds, there is actually small and subtle differences between fund managers. Coming back to the question that was raised, there are fund managers do a fantastic job, and I think our analysis only highlights the amount of effort that they do to make a difference and differentiate their strategy. It may not always work, but at least in my mind, the factor-based analysis helps you appreciate what is it that the fund manager is doing. Qfinr is available for free. You can just go onto the website. It is called www.qfinr.com. Sign up, and you can try that. Well, with that, I think I should come to an end of the discussion, or at least my presentation. Any questions and answers? I know we are slightly late.
Great, thanks, so much, Rajan. That was really a, wonderful session. Thanks for taking us through the theory in so much detail. And I think the live examples, along with the Python and the Qfinr tools were very, very helpful. In the chat box, we have responded with Rajan Raju's SSR and author profile. He's done a ton of work and research, which is publicly and freely available on factor investing. I would encourage you all to look at. There were, of course, a lot of questions on where to get the factor series that Rajan has used in this presentation. And we have in the question box given the link for the InvestPar's research section of his website, where, as he explained, on a monthly basis, he keeps updating all of the factor series that you can freely download and use. So great. So thanks so much Rajan. I think we covered a lot of ground. Thank you so much for taking out time on a Saturday and doing this for us. So as a reminder to the listeners, please complete the evaluation survey that has appeared on your screen, or will be there very shortly. So CFA Society and CFA Institute members, they can claim 1.5 professional learning credits for this session. Just a reminder, we have an excellent 9th India Wealth Management Conference, on Mumbai on 1st of, the early bird for that ends on 1st of July. So, please do register for that. We'd love to see all of you there. And also a reminder, this is the renewal season for your society and institute membership. So please renew your membership. It takes only 5 minutes. You can log in to the CFA Society India website, where all event details and upcoming event details have been posted. So you can track the entire calendar for the events there. And on that note,
Sorry. Could I just ask? There was one question I had left.
Yes, please.
Fixed income factors. Please
Sure.
watch the space. We don't have in India as of this point in time any good fixed income factors, but that's some work that is currently being done. Hopefully later this year, early next year, something should come up.
Great. On that note, we are hopeful we'll be able to have Mr. Rajan again for a future session. And on that bright, positive note, have a great weekend. Thank you so much, Rajan. Thanks all the members, and look forward to seeing all of you again sometime.
Thank you very much.